When should you use a whole life insurance policy loan instead of utilizing a bank? Well, if you listen to the infinite banking world, they would tell you that you should never use a bank loan. You should always use your policy loan. In fact, the purpose of the infinite banking concept is to take control of the banking function of your life and eliminate the need for banks. In this video, I actually had Caleb Williams from Better Wealth over at my house, good buddy of mine, and he was in town and came over one night, and it was like 9:30 at night, and we decided to have some fun and film a video and get into infinite banking, and if infinite banking, or not even infinite banking, just using policy loans really makes all the sense in the world, and what is the framework that we should use. He shares his framework. We had some really good conversations, and so I think this is gonna be a big value add to you. We ended up breaking this into a two-part video because the conversation expanded so much, so I'm really excited to get you into this. If you're an agent, I think this is gonna add a lot of value into the way that you communicate and share and understand the use of policy loans. And if you're a client that's looking to do this for yourself, I think this is gonna help answer a lot of questions that you probably have about a lot of the confusion about, does it make sense to use policy loans? Why would I take a loan against my money to make money and all these different things? And I think we're gonna be able to clear some of that up for you. But if you have any questions along the way, make sure you comment in the comment section below. I'll do my best to answer every question that I possibly can. And that's it. Until next video, have a blessed, inspirational day. But here we go, let's get into this.
I wanna turn this on you and say, Chris, what is your framework, number one, to when you think about infinite banking, when you think about being your own bank with life insurance? Number one, how do you explain that? And number two is, if someone comes to you and says, when should I use my policy, or what should I use my policy on? How do you answer that? Or what is the framework of how you teach people how to think about that? I just asked you 25 questions.
Yeah.
But I just like, this is the kind of conversation that I would love to flesh out.
Yeah.
But I want to kind of tee it up for you. And if you don't know this guy, he has an amazing channel, and you should definitely go follow him. And he likes to come after some people in the space, and so I like to just watch on the sidelines and say, good job.
he text messages me like, bro, you went there?
Yeah. I was like, wow.
All right, so here's what I would say is, I'm not a big fan of like certain sales phrases like take over the banking function of your life, which is a big infinite banking thing. And it's not that I don't agree with some of the, I don't know, the sentiment behind it. And I get the idea, but I think it's irresponsible to run wholeheartedly with the principle that we want to eliminate banks, and that we're going to be able to eliminate banks and keep full of financial efficiency in our life. Right. So from that perspective, like it bugs me, like the idea of like, hey, I'm gonna use a policy loan every single time I want to buy a car, every single time I want to, some people are preaching like pay all your bills through these things, and like it's complete insanity and irresponsible. And to me, anybody that's preaching you should run all your money for your bills through your policy should lose their license. That's my opinion. Like that's malpractice.
I don't think you're doing anyone a favor, and the insurance company doesn't like you, and ultimately I don't think the math works in your favor either.
It doesn't. And so there's that. I look at it this way, is like the more money, the one thing that Nelson Nash said that I love is that the more money you have in a whole life policy, the more opportunity has a way of tracking you down.
Golden rule.
100%.
Let the gold make the rules.
Right. Yeah. So, but I got news for you. It doesn't have to be in a whole life policy. You could have all your money in the bank account, and guess what? You're still going to have opportunity to track you down, because people that have access to massive amounts of capital have opportunity, right? Now we have to have a conversation of like, if we're going to have safe capital that's liquid, where are the best places to keep it? And I could make a really strong argument for whole life insurance when it comes to getting that dollar to perform multiple functions and looking from a long-term perspective and all these things. Okay, so let's agree on that.
So far we're agreeing that life insurance is an amazing safe asset that gives your dollars more than one job. So like you could justify why your money would be better there than like in a savings account when you look at 30 years, when you look at all the benefits.
Sure.
So now the question is, all right, Chris, I've been told that if I use my policy, I'm going to become more of a banker. When should I use my policy?
Yeah.
Because this is where I see a lot of people getting tripped up on, or a lot of questions that I'm getting.
I look at it this way. I like to use my my policy as a filter, right, for making decisions, right? So in a way, I talk a lot about financial structure, right? And the importance of building your foundation and then
this pyramid.
You talking the pyramid, right? And then you build your financial house in a certain way. And as you build your foundation, you can start taking more risk and then more risk and then more, and then, and you're diversified in the right way. And that risk can be, it's a whole conversation that's an hour long. But here's the deal. It's a filter having your money in a policy, because now you can say like, all right, based on how much money I have in there, it's a filter, and it's B, going to make you a better consumer, because it's going to force you to become more. It gives you leverage, right? Like, so let's just say I had $100,000 in a policy, right? And let's just say I wanted to buy a $70,000 car, right? I could go down and I could, like, an infinite banker would say, no, just go get a 6% policy loan.
Pay yourself back with that 7%.
Pay yourself back, pay yourself back. But here's the problem. You're going to pay a 6% policy loan, but your dividend's going to be under 6%.
Right.
You're not.
There's no arbitrage.
So there's no arbitrage. Right. And I think because of the fact that we lived in a 40-year period where there was the potential to be arbitrage, even though it wasn't really working that way, but simplistically, it was misrepresented as having positive arbitrage in the way. Even if you could get positive arbitrage, if I could go to a bank, right? I could go to a dealership. I did this with my travel trailer, that I pulled behind my Jeep. I went in and they wanted $30,000 for it. They tried to give me a loan at 4.9% for $26,000, and they're like, we're giving you a great deal, and we're going to get you a great deal on financing. But then I was able to use my policy loan, and I was able to go get it for 19.9, right?
It's amazing.
And granted, I was paying 5.3% on the policy loan to get the 19.9, but then you're able to refinance the 19.9, put the money back in the policy, and
the actual interest rate that they charge you is far greater because the cash price was a lot higher.
100%. Yeah, exactly. And that's all baked into the equation. And so, like, what I love about having the money in a policy is it gives you leverage to be a better consumer. But here's the deal. It's not the policy that made me money in that environment. It was my ability to negotiate.
Right.
It was my ability to know the game, to know that I had this asset, and it put me in the driver's seat. It put me in the power position. Because let's face it, most people, when you go in to buy a car, I went in and I did this the other day because I got to sell my Jeep, and I went and test drove brand new Jeep Gladiators, And so when we're in there, we walk into the dealership and I know what's going to happen, and they're negotiating back and forth with me, and we're playing this cat and mouse game, you know what I mean? But I know like what the deal is, and I know like what I have at my disposal, and they're trying to get me to go $59,000 for this Jeep Gladiator. And before you know it, we're at 44. Think about it.
And you could go there because you had access to capital.
Exactly. The problem is most people go into these environments and you're on your heels, right? Like you're not coming from a position of power and a good foundation, and so you don't have any leverage.
Do you have a framework when someone says, Chris, like, when should I use my policy? When should I not?
Not really, because like I think it's different for everybody. You know what I mean? Like I mean, I think there's life and then there's math, right? And sometimes math just doesn't matter. Like I could look at it like for big things, math might say, hey, I got a 2.9% interest rate on my mortgage for my house, right? So math would say, and my traditional, it's funny, I was just having this conversation like an hour and a half before you got here with somebody at a party. And math would say, never pay this house off, right? Like you got this asset, the 2.9% interest on this house is the asset. But now I'm looking around the world, I don't know how you feel about this, but I'm looking around the world, looking at the World Economic Forum, looking at Klaus Schwab, looking at BlackRock, looking at all these things. And I'm going, wow, there's really something going on where BlackRock bought 44% of the houses, in 2022, single family homes on the market, 44% were bought by private equity. And I'm like, all right, that's kind of a scary thing. And there's a lot of talk around that. So my mindset now goes beyond the math and it goes to the emotional, like, I just want to have my house paid off. Because if you have a mortgage on your house, you don't own it. And so like mathematically I go, doesn't make any sense, but now I just want to have my house paid off. Like, because emotionally I'll feel safer, right?
Yeah.
And so when it comes to your policy loan, there are some times where it's like your policy loan might save you money.
Right.
You know,
or maybe just save you peace of mind.
Might save you peace of mind. Maybe you need the flexibility. Maybe there could be a lot of reasons, and you have to judge like when is that the right time for you. And there are times where for me, having access to capital is everything. If you use your policy loan, you lose access to capital. Right. But if you leverage the banking system, and this is the problem with infinite banking, is that by telling everybody to always use the bank, your policy, and take over the banking function of your life, you're constantly leveraging everything you have, right? Instead of using other people's money, right? And when you're using your policy, you know, like if I have $100,000 and I use 70% of it, like there's an opportunity cost to not having access to that $70,000, right? And so if I'm doing that on a car, like, that's stupid. You know what I mean? Like, now there's going to be a give and a take. Like if I could pay 5% in my policy loan and I'm paying 12% for an auto loan, like maybe the number, like I would argue just don't buy the damn car. Like, you know what I mean? But I don't know. Like, so I would say it's, I don't really have a framework. I just...
Does this thing work? Like, can we put this? Because what I would love to do is jam.
So let me do this. Bang, bang.
Okay.
Go ahead.
So here's, and I want it, and I don't know if they can see
you're
me.
good. They can't see you.
Here's the thought process that I have, and I would just love to flesh this out with you. So cash flow. Cash flow is, I think we both agree that from a financial standpoint, cash flow is very, very important. The way that I see it is your money, once you have cash flow, can really do one of two things. It can be saved, which is a verb for something in the future, or it can be gone, consumed. I'll just use consumed. And consumed is like, this could be Starbucks, this could be paying the IRS, this could
taxes,
be
anything.
Taxes, whatever.
It's just money going out for lifestyle.
Right. And so then money saved is a verb, and hopefully we're making future cash flow. We get that, right? Saving is hopefully we're creating more cash flow with our savings.
Saving to invest.
Yeah, saving to invest, but ultimately another way of saying investment is buying future cash flow.
Sure.
So the way that I see it is like when we talk about life insurance, I think of, okay, I want a safe, like your money's got to reside somewhere. This is where like when you're saving, it could be in a checking account and then you could go invest it, but like, and we have lots of videos on both of our channels on like the benefits of life insurance.
Sure.
Life insurance, when it comes to the next 10, 15, 20, 30 years, so many reasons why you would want to save or store your money into life insurance versus other assets.
Totally.
What I see is almost two sections. When I think of savings, this is not life insurance, but I happen to do this in my life insurance policy. A lot of our clients happen to do this in their life insurance policy, but we could just think about this as a checking account at this point.
Sure.
There's really two forms of savings. There's an emergency, and everyone has a different tolerance here. Like I tend to be like more aggressive when it comes, like I want a year's worth of like expenses off the table because it allows me to show up more powerfully in business. It allows me to like take business risk when I know it's like, hey, if this all goes south, our mortgage will still get paid.
But that's what I talk to people about all the time is align your money with your values and beliefs. And for you, one of your values is creation and the ability to.
And I would not be an authentic creator if next week's mortgage was based on this video performing well. Like I could care less if this video doesn't do well. It's not going to change my financial life at all. Whereas if I was I would show up differently if I like needed the money. So like building an emergency fund is so important. And I just believe everything in your financial life gets better. That's why people go into credit card debt and all that stuff because they have no margin.
Sure.
Everything above this is what I call the opportunity. Okay. So this is O for opportunities. And so this is where it's like, okay, you tell me what your investments are. Is it the stock market? Is it real estate? Is it private equity funds? Is it a business? Is it education? Is it crypto? Whatever it is, not investment advice, by the way. Just like whatever activity that is. And then the question is, it's like, okay, then it comes down to what's the best way to invest in these deals. Is it taking this money and going directly, or is it going through a policy? And then it ultimately comes down to like, okay, if I'm going to invest in real estate and I can only get 4%, but I'm paying 5% to make 4%, I'm an idiot. Like that's a negative 20%. So it's like, what I love what you said about being a filter is this allows me to be like, okay, this creates a cost of capital because there's an opportunity cost of whatever I do. So I have to make sure if I'm going to use this money to invest, I got to make sure that there's a greater arbitrage and it has to be worth my time. This is another question is like, if it costs me 6% to borrow and I can earn 10% over here, I personally, Caleb Williams, is not going to say yes to that. Because why would I, knowing what I know, tie up money, take some of this, tie some of this money that's gone for 10%?
But it's not, it's...
I'm talking as an entrepreneur, Caleb. Like, mathematically that works. For me, I value control more than that 4%.
Sure, of course.
So we have to understand what your value of control is. So this is like the framework for investing. So now we go over here and say, okay, consumption is important. Like this ultimately, we like to downplay. Do you want to say something?
Well, I would say this too, just to kind of double down on that point, is you say that, I say that. And the reason is because our ability, and let's just say our intellectual property ability and our ability to build businesses and whatever, our threshold for return and control is much higher than most people's. Because if I can't grow my business by 20% a year, I consider myself a colossal failure. You know what I mean? Like that's just,
well, and just to be fully transparent, like our goal this next year is to double our business. That's 100% return. And so for me, it would be very hypocritical for me to say, I want to do this over here, but I'm going to tie up my capital, which is allowing me to show up powerfully in my business for 10%. But what I'm also not saying is you might be watching this and being like, Caleb, like the only other alternative I have is the market. And so then I'm like, okay, not giving you investment advice, but I would be having a totally different tune when it comes to that. And at the end of the day, for me, is like, if you're going to use your policy on an asset, make sure that it ultimately is getting you a greater return than the cost of borrowing. And like, there's nothing magical. Like you are an idiot if you're paying 6% and earning 5%. Trust me, you're not making money. Your policy is compounding, but guess what? It's compounding regardless if you use that. It's compounding regardless if you use that. You just did a dumb investment and increased risk, and it's costing you more. So it's like, I don't like the whole like, yes, your policy is compounding, but it's always compounding. It's going to compound regardless if you invest or not. So this is so the investment framework is your investment needs to earn greater, but then you also need to value control. So you have to have a value of control, which is fluffy, but then the thing that's really clear is like your investment has to be greater than what your cost of capital is. Otherwise, your equation is not going to be positive. So now here's where it gets trickier. This is easy because it's math, and once you have a value of control, it's ultimately really easy. Okay. The thing over here is consumption. Okay, so when we talk about consumption, it's like, okay, and can they see the screen?
They can.
Okay,
they can see both.
So consumption is a very interesting thing because we sometimes downplay it, but ultimately this is your life. This is your lifestyle. And so I have kind of come 180 on this because, first, idealistic Caleb is like, you should make your lifestyle as skimpy as possible, like all this stuff. And the more I live, I'm like, man, like this is your life. Like this is your diary that you're like, your life is a white canvas that you're painting. And so it's like our whole deal is like, be intentional. Be intentional with your one life. So the idea is like, who am I to say what you should do over here? I'm a firm believer that there's a ratio here. And at the end of the day, like if all your life is consuming, like it's not going to end well.
Eventually it's going to catch up.
Right. But over here, a lot of what people say when it comes to life insurance is like, go borrow for vacations and, cars, and cars could be an asset, but I'm just going to put it over here. And like maybe homes are over here because it's a part of your lifestyle. And so what a lot of people are teaching is like, hey, take from your policy and like go on vacation, buy cars. Like you're going to get rich when you buy cars with your policy, pay off your home and pay yourself back. And at the end of the day, I view all these And we need to put a value on everything, and which is tough. It's like, what's the value of your marriage?
Yeah.
Put a value on it. What's the value of going on vacation? Like you could literally say like, I will produce so much more. I will get a raise at work. My like a divorce is expensive and stuff. So put a value on it.
Yeah.
But my whole thing is we can't divorce ourselves and it use bad math from lifestyle to investments. Like we ultimately need to put a value on what we're doing, because regardless of going on that vacation, whether you use a policy or not, you're investing your time and money into that activity. There's a cost not just there, but it's going to compound. So all I'm saying is my framework is make sure when you use your policy that the result, whether it's over here or over here, is greater than the cost of using your money. And so like, for example, like even a car, you just have to make sure that the result is greater than the cost. And so for me, the last thing I'll say is if I had another institution over here that would allow me to get cheaper access to money, I'm taking this all day long, especially if I get to keep more control. And remember, it's not affecting my ability to save more. What I 100% agree with everyone that's teaching infinite banking and all that stuff is like, you want to maximize the money going to your life insurance policies. We all agree.
Sure.
But my whole deal is like, technically, if I can get cheaper money over here, like 4%, hypothetically, I could have more control. And technically, the money I'm saving, I could put more into here if I wanted. So if we actually want to do mathematics, you could make the argument that you could save more. You could have more money into whole life insurance by taking other people's money if it was positioned properly. I don't know if that makes any sense, but that's the framework of like.
It does make sense. I'll take it another level in the sense that if you're using your policy here for everything, right?
Yeah.
And you're using it for vacations and cars and homes, and it's like you're funding it for that, and you're using it for all your investments, and you're eliminating the banks, and you're eliminating credit cards, and you're eliminating all this stuff. I've got news for you. We live in a world where everything is based on credit and debt.
Totally.
You are not going to create credit doing this.
No.
Like you're never going to build a big enough credit score to be able to build your credit score high enough to get good leverage and good rates. And
the ironic thing is you need banks to even make this work.
I know.
Like shocker. Like
at the end, it's crazy. Like when you really think about it. And so, I don't know. I just look at it as, first of all, you should never finance any of that crap. Like, cars maybe.
You're financing if you're using cash. I mean, you know this.
Yeah. The opportunity cost.
But you're saying you should not take a policy loan for a car.
I'm saying you shouldn't leverage a bank loan, or there are certain things, lifestyle, that are just going to come with an opportunity cost. Right. That's just the way it is, guys. Like you're going to have an opportunity cost of how often you want to go out to eat, of the house that you want to live in, of the cars you want to drive, of the schools you want to put your kids in, of the activities you want to put your kids in, get ready, of the vacations you want to take. This is all lifestyle stuff that you just have to just get used to the fact that there's an opportunity cost. When you spend the dollar on that, you don't just lose that dollar, you lose the ability for that dollar to earn for you for the rest of your life. Okay, that's fine. You make that problem worse when you start adding interest expense on top of it, because now you're not just losing by paying cash for that dollar, you're adding in and paying another 4% on top of your $10,000 vacation or $2,000 vacation, whatever, $500 weekend vacation. I don't care what it is. It all is relevant and scalable to whatever income bracket you're working with. And so that's just what I look at is like, principally speaking, I think lifestyle. Figure out what lifestyle you're good with, right? Figure out what you're comfortable with. Create your own P&L, like personal P&L. I look at it as like, I hate the word budget because I think it's just very scarcity mindseted. And I think nobody likes to budget because I think it's all about restrictiveness. And I love a personal P&L statement. And the reason is because it's more of a business mindset thing. Every entrepreneur, every business owner looks at a P&L, and we're just, it's profit loss. Like, what are the inflows? What are the outflows of the business, right? Like, and so you can look at that, and the purpose of a P&L is to know what to measure to focus on being able to grow. right? And so that's why I just kind of coach all my clients to like, you got to build a personal P&L. You have to understand what that looks like. And as you're doing that, your lifestyle, you can intentionally now choose. The problem is most people don't choose intentionally enough. They make an emotional decision. They want to go buy a specific car that's probably too big of a car than they would have made. Not saying it's right or wrong, but it's probably a more expensive car than you would have chosen if you sat down and were intentional about a process.
That's good.
Right?
And debt can enable bad decisions.
100%.
Your life insurance policy can enable bad decisions.
100%.
So,
but if you're doing the P&L on top of everything, right, to like really filter through, and then you just have the policy based on the fact that it's there, it's going to empower you to show up differently in those transactions. Right? It can be a filter that you run things through that it at least gives you a control, right? It's the control that you can compare everything against and be like, is it good or bad compared to this? And then you have a foundational negotiating kind of place to start from with everything you do. And then you can kind of go from there.
Yeah. And my whole deal is this cash flow should always just increase. Like the way that you should build your financial model is like whatever you're saving today, you should figure out a way to continue to save more and more and more. And a red flag will be when your lifestyle or anything, investments or anything, limit your ability to continue to save. Because cash flow is the thing that makes the world go round. And so it's like this is a fun conversation because we may have confused a couple people even more. But like what we're trying to say is like life insurance is an amazing thing. And it doesn't necessarily, like, we're not just saying use your life insurance to go finance all your personal stuff, because you could see where you're saving, but you're really just lifestyle. And you're actually like, yes, you get the policy, but at the end of the day, if you actually look at the math, it's not working in your favor because you are charging interest. And yes, like your policy is compounding, but you're also you're paying the insurance company a premium to maybe do things that you probably shouldn't be doing.
Yeah, I mean, I think that all comes down to how much do you value the life insurance, and from when you borrow against the policy, I think the biggest thing that I want to make sure everybody's clear about is when you borrow against a policy, the thing that I see most misrepresented on the internet is that you can borrow at 5 and you're getting a 6% dividend.
Yeah, no.
Right? That's not how it works. Okay.
Do you want to break this down? Because this is like a.
Sure.
This is like this will be like part 2. So subscribe to both of our channels. We appreciate the comments. I want to know, just out of curiosity, do you listen to these things at like 1.5, 2x? You actually listen to it at 1x?
Totally.
I just want to know. I've never asked. But
I can't listen to myself in 1x anymore. I'm 2x.
I do 2x on everything. So we appreciate you. Right. Part 2 of this video is going to be about why you don't get arbitrage with infinite banking.
Ooh, this is going to burn a lot of people. There you go. See you guys.